Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor out of Singapore. Now, I'm Brian Fernandez, and it's the Friday, the 4th of November, and we have our new guest, Craig Erlam. He's a senior market analyst at Oanda. Craig, great to have you on the show.
Thanks for having me on.
Now, Craig, before we get your insights, let's take a look at how regional stock markets have performed across the first half of the trading day, as well as let's look at, for a start, how crypto markets have performed. Now, Bitcoin is at 20,318. It's down 0.18%. Ethereum is at 1,548. It's down 0.3%. Now, looking across the regional stock markets, we start with Singapore. The SGX is up 0.3%. Bursa Malaysia in the KLCI is up 0.54%. Shanghai is up 2.44%. The ASX All Ordinaries is up 0.57%. The Nikkei is down 1.8%. The Hang Seng is up a whopping 6.93%. And rounding up the numbers, we've got the Kospi, which is up 0.59%. Now, Craig, what's your view on how markets have performed in the first half of the day, particularly the outlier Hang Seng, which is now above 7% up?
Well, as I was going to say, I mean, there's no question what the outlier is here. I think generally there's a lot of uncertainty ahead of the jobs report, and I think that's probably having an influence on the fluctuations we're seeing in the run-up to this really important report later on. But then there's the outliers, and that's China and Hong Kong. And clearly we're seeing stocks soaring again. I mean, it's quite phenomenal, really, the movement that we've seen in these stocks over the course of this week based on social media rumors about COVID restrictions and how they're going to be studied to be loosened. I mean, it seems a bit far-fetched even when you hear the headlines that after 2 or 3 years of extremely tight restrictions that we're suddenly going to see any kind of severe loosening. But the markets have really bought into it over the course of this week, even with no verification, and in fact, actually one denial. We obviously heard from the health authorities 24 hours ago that this is not something that they are aware of and that they are very much adhering to the strict lockdown proceedings. So to see these markets continuing to rally aggressively is probably firstly a sign of how low they've fallen over the course of this year. Obviously, have been hit extremely hard from a combination of COVID restrictions and the issues in the property market, and obviously global economic sentiment as well. And maybe they've fallen so low that people are leaping at the opportunity to buy a potential bullish story. But like I say, unfounded story at this point in time, and seems a little far-fetched to me.
Now, Craig, I want to ask you about the non-farm payrolls, employment numbers that are coming out later today, as you mentioned. What is the expectation on the markets in terms of the numbers that the investors would be happy to see?
So it's always hard to say what numbers investors would be happy to see. Ultimately, what the investors will be happy to see is a number that makes the Fed ease off the brake. And while it's signaled that we'll do so in December on Wednesday, what it also said on Wednesday is they think interest rates are going to go higher. So that's not going to be enough in and of itself. So I think what investors want to see is a slowdown in jobs growth. And that sounds so counterintuitive, but that's what we need to see if we want to see lower interest rates at this point in time. And higher interest rates could be far more damaging than a few bad jobs reports. So I think what investors want to see is low levels of jobs growth. They don't want to see the economy crashing. They want to see a gradual easing of conditions in the labour market. So I'd say slightly lower jobs growth and slightly lower wage growth would be ideal. I think the key one would be higher participation. I think that would be the ultimate scenario here, is that participation rises back towards pre-pandemic levels, even above pre-pandemic levels, creating that additional slack in the labour market without coming at the expense of job losses. That could obviously help things quite considerably, but that feels unlikely at this point in time because we have dropped well below the pre-pandemic levels, and we haven't really recovered in any significant way due to a combination of people leaving the labour force because of early retirement or long-term sickness as a result of COVID. So that seems the less likely option here, which leaves us back to wages and and job growth, and they are ultimately intrinsically tied. Wages are rising strongly because of high inflation and because of a very tight labour market. So we ultimately need to see that labour market loosening. So we need to see a weak jobs report ultimately, but we haven't really seen many of them yet.
Now, from very positive numbers overall still in the US to really a dire scenario in the UK. Now, the Bank of England has basically warned that the UK is facing its longest recession since records begin and raised its interest rates by the most since 1989. So rates have gone to 3% from 2.25%. Craig, from your end of the woods, what does this mean for markets?
It means it's not a great time to be British, first and foremost. That's a terrible combination. The biggest rate rise in decades and the worst recession. But I mean, I think we have to take into consideration two things. The projections were based off two very variable factors. One is market rates, and the Bank of England was very clear that it does not agree with market rates, and they really pushed back about that. They used charting to highlight where inflation will go over the next 3 years if markets are correct in terms of what will happen with interest rates. They think the inflation will go to zero, even maybe negative, which is obviously not their target. So what they're effectively indicating here is that rates should not have to rise as much as markets anticipate. So that's one anomaly that could very much change and therefore change the economic outlook. And the other anomaly is the budget. We've had, since the Bank of England last met, we've had 3 prime ministers, or since the last monetary policy report, we've had 3 prime ministers, 3 different economic plans, and the last of which we know very little about. So the Bank of England is working off the assumption of a revised economic projection, or a revised economic agenda, should I say, from a previous prime minister whose initial economic agenda crashed the markets. So how much can we really read into these economic projections? Probably not too much. We should probably be taking them with the intention with which they were delivered, which is the Bank of England is trying to send a message to the markets: you are being far too aggressive with your expectations here. You need to rein them in a little bit. What they're effectively saying is, with the rate remaining as it is at 3%, you're closer to the truth of the matter of where the terminal rate is going to be than where markets were pricing in closer to 5%. They were saying that inflation will be a little above 2% in the event of interest rates being 3% and closer to zero with the market-based expectations. So that is considerable difference. So the Bank of England Governor Andrew Bailey said repeatedly that the answer lies somewhere in the middle, and they're not going to say where at this point in time, because they're not in the business of predicting the future, but they're effectively pushing back heavily against market expectations. But obviously has a massive difference on the growth outcome. We're talking about one of the worst recessions in living memory, with 2008 being only a little bit worse in the event of market-based expectations. And in the other scenario, we're looking at a shallow recession lasting a few years. So very different expectations. You've got to take it with a pinch of salt, I think. I think the next meeting, I know that it sounds easy to say, but the next meeting in February, I think we'll have a lot more data, we'll have a lot more information, and we'll have a budget, which is a massive step ahead of where we are now.
Now, Craig, thank you very much for your insights, and thanks a lot for coming on the show.
Thank you.
Now, I'm Brian Fernandez, and we've been speaking to Craig Erlam, the Senior Market Analyst at Oanda, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. This show will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.